We'll go through just an overview of like understanding the balance sheet, but understanding it from an owner's perspective. Then we're going to do the income statement as well as the cash flow. And then we're going to talk through some financial ratios that you'll need, especially as you're looking at investors, some of the ratios that they're going to run, and that you'll need if you're looking for lending. So the first thing is, why are financial statements important for business owners? So they help you understand your financial health, and they also give you the essentials that you're going to need for securing and funding and investors. A lot of times people may do their financial statements for tax purposes. Raise your hand if you do annual financial statements just to get your tax return out the door for your business. And that may have been the only reason why you felt like you needed financial statements. So we're going to talk through some of those, because when you have that perspective of doing financials just for your tax, sometimes you may look at it as, I want to declare as many expenses as possible, right? So I can have a lower um, tax bill. That is great, but we're also going to talk about what that does when an investor is looking at it or when a lender is looking at it. So I see, yes, everyone says, yep. That's the only reason why I do my financials, and that is very common. So, and then financial statements can provide you an insight to make strategic business decisions. And so we're going to leverage these financial statements on oh, okay. I'm going to just click all of them so they come up. And so we're going to get into 5 or 6 myths that we have, and so the and this one was added at the last minute, so I didn't change the slide. But a, one myth that people have is accounting software would do the accounting for me. How many people believe if you get a good accounting software like QBO and all of that, your accounting is done, is user friendly, and I should be able to do this myself? Just raise of hands. I wish I could see their reactions. No,
They're saying no.
no one believes that. Well, good, great, because many people, when they're starting a business, that is something that they do look into. And to your point, it is no, because if you don't know where you're putting the different information, you're going to get inaccurate results. Another myth is financial statements are only needed for tax purposes. So we kind of already talked about that, but we'll go into a little bit more. And primarily, it's the essence of when you're looking at it only from the standpoint of taxes, you're not leveraging the information to be able to make good business decisions on. But then on top of that, you may be including certain expenses that if a lender or an investor were looking at the financial statements, they will draw a different conclusion on how your business is going. Um, how many people do budget for their financials? Like throughout the year. Raise your hand, put it in the chat. Yes. I see a couple of hands going up. Okay. I've seen just a handful. Okay, great. I love it. Keisha and Don Nicole are like, yes, we do budget. So one of the great things about budget is um, it does give you insight of what you're expecting, but it is not a control process. A lot of times people put in a budget and they're like, oh, this is going to control my expenses and all of that. It does not. And so that's one of the biggest myths. Another thing is deficits are better than surpluses. And when I say a deficit, I mean sometimes a loss. So you like, a net loss for tax purposes is better than a surplus. That is not the case. Income is more important than assets. How many people believe income is more important than assets? Okay, we'll dive into why that's one of the myths. It can be important, but assets are just as important in a couple of different ways. And we'll talk through that as we get through the balance sheet. And then a bookkeeper is the same as an accountant. How many people believe that? Okay, I see one head nod. Yep, everyone is saying no. A bookkeeper is not the same as an accountant. And the biggest thing difference with an accountant is you want someone to be a strategic advisor. So it's not just about getting the historical things of what you've done in the right place, but it's being able to read the financial statements and help you identify different opportunities of where you need to go and what you need to leverage in order to grow. Okay, so let's get into just high level what reporting is. I promise you, I'm not going to try to use a lot of accounting lingo and all of that. You know, they say accounting is a whole nother language in and of itself, but we're just going to give a baseline. So assets, that is everything you own. So that's your cash, your inventory, furniture, and equipment. Those are considered as assets, right? Then you have your liabilities. That is everything the company owes. So that's your loans, your credit cards, mortgages, anything that you own is a or that you owe somebody else. That's a liability. Then you come into your revenue, and so these are funds that are received from your business. They can be broken out by certain programs and categories depending on if you have different revenue streams. And then you have your expenses, and these are things that you pay. So utilities, taxes, if you do advertising, if you payroll, all of that represents uh, the balance sheet and income statement. And I promise you, well, I can't promise you that that will be the last accounting lingo that I use, but that will be the bulk of the accounting lingo that we're going to use during this session. So, um, as we get into your financial health, one of the things that financial statements do is they're going to provide a snapshot of your financial position. So, as you're looking at it from a point in time, that's where you're going to look at your balance sheet. And your balance sheet is really going to entail your assets, your liabilities, and your equity. And so, equity is going to be that piece that a lot of your investors are going to look at. So it's not just your assets and liabilities, but they want to know how much investments has an owner put in. If you already gotten additional investors, how much do they own? What are they taking out of the business to pay themselves versus what are they leaving in the company to use to grow, to make sure that you have enough for your operational expenses. So, your financial statements also help owners identify the areas where there could be overspending or where they could cut costs. And this is mostly going to be on your income statement. So, whereas your balance sheet is going to show your assets, liabilities, and equity at a point in time in that snapshot, your income statement is really going to show you a level of where your overspending is, where some of your profitability can be taken. And then lastly, your owners can use financial statements to evaluate the performance of their business and make informed decisions about investments and expansion plans. So, as we talk through the balance sheet, some of the things that you want to keep track of is your balance sheet is your progression over time. So, take for example, as we get through your accounts receivable, right? Now, accounts receivable, we say is an asset, but it can be a liability if your people don't pay, your customers don't pay. Whether we like to admit it or not, managing our accounts receivable and our accounts payable really helps to leverage some business decisions that we need to make in the future, right? And so, as we start looking at it, your balance sheet, we're going to start with the accounts receivable. And so, what are accounts receivable? That's when you give product to a customer and you expect payment at some other point in time, right? So, how many of you guys have accounts receivable right now on your books? Or do you all collect payment at the time that you deliver a service? Okay, a few people say yes. So, if you're in construction, most times if you're providing services, a lot of times you will do some of the work before you get paid. And so one of the biggest things about accounts receivable is bad debt expense. And bad debt is when your customer does not pay, you are out that cost. So one of the things to help manage your accounts receivable is not just in the collection of payment terms, which payment terms are great, because they tell them when to pay. If you have a payment term of 30 days, then you have to know that you need to be able to have 60 days worth of money in the bank to handle your operation, because you're not going to get paid for that 30 days. But how many people know everybody doesn't pay on time, right? So if they don't pay on time, and if you're budgeting exactly when that payment is due, um, eh, what happens is if payment is late, it's going to impact how you're able to operate in the future, how you're able to meet future contracts, how you're able to buy additional inventory. So some of the things that can break up that risk for you is doing progress bills. So if you are in servicing, if you are in construction, making sure you get down payments, um, making sure that you bill according to as you're progressing. Like if you are doing a presentation and you know that in order to do this presentation, I need to spend X amount of hours, X amount of days, months in advance in preparing for this. One of the things that you can do is say, okay, let's get a down payment. And that down payment would, number one, show investment, right, into what you're about to do, but it will also help to funnel the expenses that you're going to incur as a result of this. And if you're like, well, it's just my time, but here's the thing. If your time is valuable, your time is money, right? So even if you're not delivering a product or doing construction and all of that, if you're doing services and it's your time, that's time that you're not spending doing other things. So you want to make sure that as you're looking at your accounts receivables, that you structure your contracts in a way that you're getting paid along the process. If you make candles, I think there's a candle maker in the house, right? You got to buy all the products. You got to
Yeah.
buy the different scents. You got to stack your inventory, and we're going to get into inventory too, because that's part of the balance sheet where inventory is not always a good thing. And so, but in that, there's a cost, upfront cost that you are giving as goodwill. Now, 100% can't be goodwill. It has to be a mutual contract. It has to be a mutual agreement, right? So it's okay to say, you know what, do the deposits, and maybe the deposits are for the cost of your material that you know you're going to have to do. And it gives skin in the game that this is a mutual agreement. So all the pressure is not on you. Anything before I move on from accounts receivable? And like
Now,
I
we
said,
do have a comment in the chat, and it's a fire. She's saying this is fire.
oh,
That means it's
okay.
really good.
Awesome. Awesome. So we're going to move on to the next one, balance sheet, and that's accounts payable. So now there's the flip side, because you're going to owe people money in doing your business. And so one of the things of it is looking at your accounts payable in the essence of not first come, first serve, like first invoice in is the first one you pay. Can be a process, but let's not do that. Let's look at terms of your accounts payable for your vendors. So some that have like early payment and you get a discount. Discount is real money, right? So for those, I would probably pay those early versus some of the other ones that I may pay on time. Also looking at how much you're spending. So with accounts payable, and inventory is going to be our next topic, you want to make sure that you're not buying a whole bunch of stuff that's going to be due in 30 days, and you know you don't get paid in 60 days from your customers, right? So you want to look at, the balancing of your accounts payable and not look at it as you want to look at your vendors of importance, right? So every vendor is not rated the same. There are some vendors that, if the value, not that you don't value all of their relationships, but you got to value them differently for your business. If there is a vendor where, I cannot go anywhere else to get this right now. Number one, we need to diversify your vendor pool too, because you never want to be in a situation where you're linked in with one vendor, just in case they can go bankrupt. They can have other customers that come in and not meet expectations. So always know, your vendor markets, especially the critical ones. And the critical ones are going to be the ones that impact your ability to do business. Meaning, if it's your inventory, right? You want to make sure, yes, you may have one contract with a vendor to do the bulk of your buying your supplies that you need to make your products, or if it's a service, and if there's certain templates and stuff like that that you need, whatever those vendors are that are critical to meeting your customers needs and your product or your service in a timely manner that's not going to impact quality. You should have your go-tos, right? Because you can always negotiate. When you do more with that vendor, you could negotiate your price. If you're small and you haven't done enough with them to negotiate price, you can negotiate payment terms. You can negotiate discounts. Hey, if I pay you early, if you are able to, if I pay you like in 20 days rather than 30 days, can I get a 10% discount? And if you are able to do that, take the 10% and use it for your to purchase more things, right? Or if you're like, listen, I buy a lot from you, and because of the quantity that I'm buying, I want to reduce price. I want a discount. And if you've been with a vendor for a really long time, it's important to shop the market. Do your due diligence, because prices change, more people come into the different spectrums, and you'll may be able to provide the same quality and get a better rate, or it helps you in your negotiation with that vendor and that contract. All right, now we're going to move on to inventory. So I love inventory. I love it for two reasons. Um, Inventory, I find, is good and bad. So, what inventory is good is, obviously you want a certain amount on hand so you can meet customer demand. When inventory becomes bad is when you do not manage it properly. Meaning, if you and just because I see Keisha on my screen, probably because she was the last person that talked, and I know she makes candles, right? And I know she has different scents. So, say if Keisha decides, I'm going to have inventory on hand with 30 different scents. Well, now Keisha needs to use her money to allocate enough inventory on hand for 30 different scents. But what happens if there's only four major scents that most of her customers use? Now, Keisha has already spent the money for the 30, and she may not be able to replenish the money to meet the demand of the four. So, where inventory becomes important for people is you got to see what's churning. You cannot stretch, like, you're only going to get a certain amount, you only have a certain amount of money in the bank, right? And as much as we love for our customers to pay early and all of this stuff, at the same time, what you do with your money, if it is stretched too thin, it can put you in a bind. It could put you in a hole. If I think Chef Maria is on, and I'm sure that food has a shelf life, a very short shelf life, which is why if you're in the food industry, it's really, really hard. And so if you buy too many products that you end up throwing away, it's called sunk costs. It's real cost, and it's an expense to your company. And this is what it becomes on the management. So when you're looking at your inventory, although inventory is an asset, there is a thing for disposal of inventory. That means inventory that's not going to sell. If you sell something and you know that, hey, trends change, like a boutique store, and fashion will always change. So the average shelf life for retail on clothing is 3 months. So if you got more inventory than a 3 months of how much you can turn it, more likely than not, you're going to put things on clearance. You're going to put things on sales, or you're just going to write it off. You want to manage that. And that's one of the things that your balance sheet helps you, gives you the snapshot, because what it's going to take is all inventory. So whether you purchased that inventory last year, 2 years ago, is going to be on your balance sheet as an asset. But at some point in time, if an investor is going to look, they're going to ask those questions like, how often they're going to look at your cost of goods sold, and it's like, wait a minute, your inventory is say $500,000, but you're only turning about 200,000 in a year. Why are you spending, rather than spending the $300,000 on other parts of your business? Why do you have it held up in inventory? And if your inventory does have a shelf life, what are the chances that you're actually going to get a return on that cost that you spent? And so this is one of the ratios that they will use to judge your business. This is one of the things that you can use for management of your business. Before we get off of balance sheet, and I know I didn't cover everything, and there's other lines on a balance sheet. Does anybody have anything? Yes, Don Nicole.
First of all, this is so good. I just want you to know I know that you can't see our faces in the comments, but this is in some cases new, fresh information. Thank you. Here's a question. You did a great job talking about like a physical inventory for folks with retail products. How do you manage or value the cost of goods sold when you offer service-based businesses like many of the women on this call? Is there, yeah.
Because we're getting into the income statement, which
Oh,
that is
lovely.
exactly where cost of goods sold is. So you are
Awesome.
right on. So I think we good on the balance sheet, right? We can go to the income statement, and
Yep.
that's awesome.
Awesome.
Okay. Yes, and this is where a lot of services are going to spend their time. So with the income statement, we all know about the revenue, but we're going to talk about the gross margin, because that's where that cost of goods sold is going to come in, or cost of service, right, is going to come in. So your gross margin is very important. And what that equation is taking your revenue and the cost that it takes for you to achieve that revenue. So what it's not including any fixed costs that you're gonna have to pay regardless of whether you make a sale or not. This is including what is the cost for that sale. So for services, it may be a contractor's time, right? So we're a service industry, so we bill our time, and so that's part of our cost of service. It could be delivery. It could be the product cost. Every industry has certain cost of goods sold or cost of sales. If your service, you won't have goods, tangible goods, but you're going to have the goods of whether it's a domain or system that you're using to provide the service. If you're like marketing, right, it's probably going to be the cost that it takes to create a logo. And so whatever that digital platform is, that can go against there. Now, most times that's going to be, if you don't have any sales, guess what? You're not going to have any cost of goods sold. You're not going to have any cost of service. Go ahead, Keisha, with your question.
I'm sorry. We do have a question about the last segment. Tania asked, what's the appropriate length of keeping inventory with artwork? She feels that it's much different because there's no shelf life.
So it is different because there is no shelf life. But what I would say in the essence of artwork is, and this is going to be the essence for anybody, is you have to look at the trends, right? So if you say with artwork, hey, I'm going to spend the same amount of supplies for creating this art piece, and this art piece, it may sell or it may not sell, but say if you have a genre of art that typically sells, and you have ones that you may want to be creative and test the market. I will say whatever supplies you need for that genre that typically sells, that should be the main place where you spend your money on inventory. For the other ones, test the market. So it doesn't mean you don't buy inventory to test it, but you shouldn't buy the same quantity with the expectation that you're going to use those supplies. Now, if you say, hey, there's no difference in any supplies that I use, then you know that's that's something where your cost is going to be spent regardless of what type of art piece you create. But if there's a different cost in certain art pieces that you're creating, I would say be mindful of what's selling and allocate your cost more into those supplies.
That's great. She said that's very helpful.
Okay. Any other questions? Don Nicole, did you have a question?
No, is my hand raised? I'm so sorry.
No, you're good.
Oh,
You're good. So yes. Oh, Chef Maria, go ahead.
Yeah, thank you. This is, excuse me. This is really good information, and my little brain is on overdrive because you probably didn't see it in the chat, but when I transitioned from doing catering to the services side, I have a whole supply room full of, packaging and pans and this and that and, stuff that I'm working on getting rid of in my imaginary free time. But I don't know where that falls in terms of, I mean, it was purchased, so it showed up on my financials, at some point. But,
Yeah.
some of those things were purchased probably 7, 10 years ago. It just depends on what it is.
Yeah.
Because pots and pans and, those things, they don't wear out. You don't have to replace them, very
Right.
frequently. So,
Now, question for you. Are
okay.
you paying storage for them?
No. Mm-mm.
Okay. Okay.
No.
So this is a great example of I purchased things, but I changed, realigned my business. So I'm not necessarily using it as much, and I have no recurring costs. Because if you had storage, I would say no, there's still a cost that you're allocating,
Right.
but because you don't have costs for it, then you've already expensed that, and you've expensed it years ago. And so the good thing is, though, you recognize you changed your business, and you are no longer acquiring more. And see, what happens a lot of times that I see is like when companies aren't paying attention, right, with how they're spending their money, and they look at everything that they buy as an asset. And I'm like, everything's not an asset unless it's going to turn some money, right? And so
Mhm.
you got to look at it that way of, yes, there was a time when your business required it. And here's the great thing, you can always have that stuff since there is not a shelf life. And if you decided to do special events where you do need that, you have it. As long as you're not spending money on storage
Mhm.
and it has no shelf life, keep it. You've
Mm,
already expensed it. It already hit your P&L. I mean,
right.
unless you want to free up space. It's taking someone's space, whether it's taking the space at your home and
Mhm.
stuff. If you want to free up space and sell it, donate it and all of that, your company has already recognized that expense, and there's no additional expense that it's recognizing. So you
Mhm.
have options on it.
Okay. Yeah, and I'll just make this super short. In Mecklenburg County, well, that's right, you're in Charlotte. They do the business personal property tax, but what I pay on that each year is like under $10 a year. I mean, it's super cheap. So,
Right.
yeah. But thank you.
Yeah. And you do it yourself. You don't pay somebody to do
Oh
that
no,
at
I
all.
do. That form is so easy. No, I do it.
Yeah. I was about to say, don't pay anybody for it. When it gets a little bit more complex, then that's when you need a specialist. But yeah.
Yeah,
So
thank you.
no problem. Any other questions? All right, so let's talk a little bit more about the P&L. And so here's the thing about the P&L that's you're going to get a lot of benefits from. So yes, it's going to tell you your profits and your loss. We talked about the gross margins, and so the gross margin is your revenue and then your cost of goods sold or your cost of service, and that's the margin. So that's saying that this is how much it truly costs to deliver this service, to deliver this product. But then you're going to have additional expenses, right? You're going to have salary. So you may have an administrator on hand. You got to pay her whether you make one sale or not, or him, whether you make one sale or not. You may have utilities. If you own a location, you got to pay that whether you have a sale or not. You got to pay rent, and all of those things, right, comes into play. And the reason why they come down, those I'd like to call are a little bit more of your fixed costs. These are costs that matter because if you don't have electricity, you may not be able to do, they're like indirect impacts to your business, but they're still real costs. They're money that you're spending that you're not going to be able to pour back into the company. Like you can't spend that money buying more inventory. Marketing and advertising. It has indirect impact to your revenue if you market well and if you have a good advertising website, especially if you're in the service industry, right? That matters. But at the same time, you can't correlate good marketing to a direct sell. So that becomes part of your general and administrative expenses. And those are ones that you look at every year. And so every year, how many of you guys do look at your P&Ls for the last 3 years, like side by side? Okay, so what we're going to start doing, because everyone does a P&L for their tax accountant, and maybe your tax accountant is the one who puts it together, right? You want to ask them, hey, can you give me my P&L for the last 3 years? And this is why this is important and why I say 3 years is when you look at 3 years, one of the things you're going to notice is trends, right? So you're going to notice, hey, my rent increased like 20-30%. Well, guess what? There may be an opportunity to go and shop around and see, can I go somewhere else and pay a significantly less amount? Or utilities are really good for having hidden fees in it. And so I had one client, they're a retail, they have like 30 stores, retail stores. And they're all of these hidden fees that they were paying within their utilities company ended up, and those hidden fees were not part of their original contract. We ended up saving them $300,000 a year. That's real money. Now, granted, they were spending, but it was about 50%. So they were spending about 600,000, and we ended up saving 300,000. So that's just real money in their pocket. But it's through going through and looking at how your expenses are increasing. When your cost of goods sold are increasing, that might be a time to start looking at the suppliers that you're using and seeing if you need to go out to market, right? The other thing it's going to do is going to show you how much money do you really need to make in order to net zero. Meaning, you have your fixed expense. You're going to have to pay utilities. You're going to have to pay your people. You're going to have to pay for all of these things regardless. So what is that expense going to be? And that becomes like your break even. And then you can add in the variable of how much supplies do you need to make for X amount of revenue, and how much time do you need to spend if you're doing a service or a presentation, and and what is your salary based off of that time, and you can estimate kind of that cost of sales, cost of service amount. But in it starts to say, based off of how you're spending your money, based off of the obligations that you've already contracted yourself to, this is what I need to break even. And then you start thinking about, well, how much excess do I want so I can pour into my company in a better way, right? And then you start holding people accountable. Is that marketing firm that I'm using, am I really seeing a pickup of benefits from that? Am I asking people how they're hearing about me? Is it more just my word of mouth, or is it my website? Is it the things that I'm doing on social media and all of that stuff? And so then you start allocating how to spend your money and what buckets you're going to prioritize and what changes you're going to make decisions on how to grow. and how to leverage. So I said a lot. I want to pause. Any questions on that?
Well, you did say a lot, and all of that was really, really good information. Thank you so much, Stephanie.
Okay. All right. So then let's move on and let's understand now. Most people don't spend time on the cash flow statement. And I will say the cash flow statement is probably one of the most important financial statements for a business owner. And the reason for it is we talked about all of the balance sheet and the P&L. Like the P&L is great to do side by side, so you can do trends and all that. The balance sheet gives you a snapshot for a point in time. Your cash flow statement is really going to be the deciding factor that gives you the snapshot of where you're spending your money. And your cash flow statement is made up of three different groups. You have operating. So this is the cost of like your inventory, your accounts receivable, things, everything you need in the operation of your business from the standpoint of making the sale. So the cost related to making that sale, as well as the income received from that sale. All of that is in your operating activities, right? But then you got to get into your financing activities. So financing activities are things that you're using that you're saying, hey, this should be considered possibly an asset or a liability. So one financing activity is going to be fixed assets. So if you're buying a laptop for your company and that laptop is going to make you more efficient, or if there's a program or a software that you're buying, that's considered as an asset. And it's a financing activity in the essence of you're leveraging that your capital to provide benefits over a long period of time, right? Another financing activity is loans and the interest that you are paying on your loans. So that is a key factor in where your money is going. Because if you've already gotten loans, it doesn't necessarily show up a lot on your income statement, but this is real money going out. And you don't have a choice but to pay that loan back. Otherwise, they can call your loan. And so one of the things to keep in mind is that you want to look at all of the inflows and all of the outflows of your cash. And you want to begin to understand what, based off of how much money I'm getting in and how much I'm spending in a year, does the math work, right? And then there's going to be certain things that you can control. Like you can control how much you spend on inventory, how much you spend on fixed assets. But things like loans, once you have that loan and that contract is signed, unless you refinance and renegotiate those terms, it's uncontrollable costs, right? And then and the last section is the investments, right? And this is how much money are you spending to invest in your business. So if it's saying I'm buying another machine and this machine will allow me to do my job faster, and the market shows that, hey, if I had capacity, more capacity, I can create more units, but I can also sell those units. So it is important for you to understand the market. It's great to be able to be more efficient, but if you're spending so much money and creating these efficiencies and not enough in the marketing segment and the branding segment, will you still get a return on that investment, right? Because yeah, it can shoot out twice as much, but if you can't sell twice as much, maybe you need to allocate that money on marketing as well as allocate some money towards getting things that will, from an automation standpoint, from a machine or anything that's going to make it more efficient for you to deliver the goods or service. Any questions there?
No, ma'am.
All right. So we are coming up on the end. And so the last thing I want to say is that when investors and lenders look at your financial statements, and you as well, they'll look at a couple of different things. So you have liquidity ratios, right? And so that's where the company has the ability to pay off their short term debt. So they look at your liquid assets. So liquid assets are things you can turn really quick, meaning cash. Accounts receivable, if you have a trend of actually collecting money from your customers, then accounts receivable will be considered as a liquid asset. Even inventory can be liquid if you have a trend of being able to manage your inventory well and turn it into revenue. So all of that, those things can be used, and then they measure it against, well, how much is your debt? And so it's pretty much how much money have you not already pre-committed to spend on certain things like paying back loans and all of that, that you can then use to reinvest in the company. So this is and there's a slew of different liquidity ratios that you can use. There's like a current assets to current liabilities. There's one that has your debt and equity, because here's another thing. If at the end of every year, you're leaving very little profit and you're taking what profit that you did have, your net income, and you are making a distribution to yourself or and the other owners, that too is also another driver, because what you're telling lenders is when we had a situation where someone wanted to get a loan, right? But they would take almost all of their money out of the business over every year to pay the owners. And so they left very little in it. And so what happened was, our thing was, well, if you go to a lender, they're going to look at your history of how much you're paying yourself, and they're looking at it in the essence of, you are not reinvesting some of your money into your business to grow, but you want to use our money to invest and grow. And the amount of money that you're asking for is more money than what you generate in a year. So, and right now, you have all of these distributions, and they actually had loans that they got from the owners and all of that. And now they're asking for a third party, a bank, to give loans. And so the bank is like, you pretty much want us to pay money to pay owners back. Banks usually want to loan money to a business so they can leverage it to grow their business, not so that they can fill owners' pockets. So you see how the essence of them looking at your equity section, looking at how much money are you taking out? Are you leaving money to reinvest in your company? And with those reinvestments, are you making smart decisions about it? Impacts the amount of your loan, right? Also, with what you're asking for your loan, if they're wanting to see, do you have the capability to pay us back? If you're asking for $100,000, but your business will typically generate, maybe $20,000 a year, they want to understand, well, what is that $100,000 for? Is that $100,000 because you need to buy some type of equipment that's going to allow you to sell more, right? Is the capacity of why you're hitting that limit because it's just you? You need more people, right? And more manpower. Well, that's a business decision. That makes sense. But if it's you got a tendency of just taking all money that your business is making out for the business owners, it may be a little bit harder to say, hey, I need this $100,000 and I'm going to use it for the business. When they're looking at the history of any money that you got, you didn't use for the business, you used it to just pay yourself. And then you have your profitability ratios. And so the profitability ratios measures the company's ability to generate profits. And so this is going to be kind of like your gross margin. of what we talked about. It's going to be understanding what is the fixed and variable cost that it creates for a unit. It's going to look at, historical more than 1 year, a lot of times, of your profit and loss statement to kind of begin to understand, where's that measurement? Like, does it cost you more to make a sale, right? If it's costing you more, then what are those things that we can do to reduce that cost? So, because you should always want to make a profit, a gross margin, because you got other expenses that are indirectly related to that sale that you got to account for. Plus, you want some money to reinvest back into the company so you can grow. So that concludes just a little bit of the financial health, the different ratios, understanding the balance sheet, the income statement, and the cash flow. Any questions? I know we're coming up on time, so any final questions or specific topics that you guys would like for me to address that I have not done so already?
Hey, Stephanie, I just want to first of all jump in. I'm going to open up the floor in just a second, but I want to tell you thank you for finally someone is delivering this information with an angle of women in business suppliers as we go to do bigger business, as we go to grow our teams, as we potentially bring on venture capital. Thank you for that. I think that was the angle needed, and I appreciate it. One thing I had never heard before, I just want to give you my takeaway and then open it up, is no one ever said before that potential investors may look at your balance sheet specifically to see how you reinvest back into your business, right? Like, are you growing your team? Are you, investing in an accountant, a new team member? They're more likely to give you the funding. That makes sense, but no one's ever put it that way. So thank you for doing that. Without further ado, we do have a few minutes for questions. So I'm going to just open it up to see if you all will either share your questions, feel free to come off mute if possible for engagement, or your takeaways. Maybe you don't have a question, but you had an aha moment. I think Stephanie would appreciate that too. So I'm going to open it up to our audience here.
Hi, Stephanie. I think it was really good information. It was a lot to think about, to consider. And I don't think I had heard it before about looking at what did you say? The profit and loss over 3 years
Mm-hmm. Yeah.
to compare.
Building your
And
profit and loss over 3 years.
yeah, I think a lot of times, as women, sometimes our financials just kind of scare us a little bit. So maybe, we're not looking at them as much and as often as we should and using them to make decisions, moving forward or see where we're spending, too much or maybe not enough. So I think it was just really eye-opening and educational and empowering us to get our head out of the sand, maybe just a little bit. So thank you.
Thank you.
Mhm.
Anyone else? Any more questions before we come to a close or takeaways? An aha moment that Stephanie helped us to realize today. All right.
I think there's one in the chat. So, what happens when your service is a done for you service that includes supplies? Which documents should I focus on more for financial wellness? I think it's Takesha. Can you elaborate on the service is a done for you service that includes supplies?
Yes. So first off, thank you for all of this fire. All the emojis have been going off in my mind and on the screen for you. So with the done for you service, and some clients may say, hey, I already have these particular supplies. Can you just come and do this particular presentation? But it also includes several other things within that. So doing a package that does it for them, they don't have to get a place to book like
Mm-hmm.
location and all those things. Sometimes I go in and I do those if they provide that service for their teams. So my question is, like, with all of the P&L, with the balance sheet and everything, I'm wanting to see which one I should start focusing on more to see financially where my business is either putting in time or
Yeah.
supplies and things like that, if that makes sense. Or
No, that's a great question. So, and let me rephrase it just to make sure I fully in understanding. You have multiple revenue streams. So
Yes.
those revenue streams sometimes it can be a service, it can be, going out and helping them find a location for their event and all of that. And you want to understand, where do I need to focus my time if I needed to, tailor some things. And so my question for you, and I probably should have addressed this, and I'm so glad you brought it up, is when you have in your business multiple revenue streams, are you guys tracking the cost as well as the revenue based off of those multiple, those different streams? Or are you just packaging it and only tracking it by customer?
So I do both. So like on the invoice, it says just done for you. So there's one particular package, but then also there's areas up there. Some clients may want to know differently. So I may put something separate, but there's
Yeah,
a line item that says, hey, this was the art facilitation. This
right.
was the actual presentation. This was the art creation.
Yeah.
And then this was the educational piece. So I will break those things down so I can go back later. Even if someone got a package, I can see which package or which
Mm-hmm.
line item people are choosing more for
Yes.
their packages. So I'm doing both in a sense, but I
Oh,
wanted to see kind of which one I should be focusing on, which balance sheet or P&L, because I'm kind
so
of
that's going to be on your
growing
P&L.
in this
It's going to be your P&L is going to help you in
area.
that. And
Okay.
so what you
Okay.
want on your P&L, so you're invoicing them and you're showing the different services and products and everything that you're providing. On your P&L too, you want to break it out. It may be the same customer, but break it out under those different revenue streams and then also break out that cost. And so what you see a lot of times is people will look at the gross margin based off of the revenue stream. So like you said, the art facilitation. Well, it costs X amount of my time, and just take your salary, divide it, whatever that time is, right? And anything else that it costs.